we're setting the stage for how to borrow money, but the way to pay it back is 89 years old, and we've never had a class on how the bank makes its money. Okay? When you can be convinced that it's okay to pay out 80% of your money, 73 to 80% of your money goes to interest, and you would not do it to buy gasoline or to buy food, why are we using this system to buy houses? So let me show you that there is a huge and gaping weakness in the bank system to lend us money, that we can use their system to our advantage. If you want to know how to use this current system, I mean, you don't even have to refinance your mortgage. You don't have to recast your mortgage. You don't have to make more money. All right. So let's take a look at this. I'm going to break this down for percentage's sake. All right. Now, the first thing I want to show you is, based on what you're seeing here, what happens when people refinance to try to save money? What happens when you refinance to try to save money? Okay, the interest rates will go down, and we're going to refinance to save money. Most people refinance every 5 to 7 years. If we're into this loan for 5 years, look at this. We paid it down by $24,000, cost us $101,000 in interest. We've already done. So now we owe $325,690.07. So we're going to copy that. We're going to pull up a new one here, and we're going to put that into the principal amount. All right. And we were at 6%. Let's just say that interest rates dropped a whole 2 points down to 4%. All right. But do you realize most people, now they're 5 years in, when most people get a refinance, do you realize what they're doing? They're refinancing you to a whole new 30-year loan most of the time. That's what makes the difference in the payment. That is the thing that causes the payment to go down more, is by dividing what you owe by another 360 payments. So now my new payment is $1,554.89. All right. Yeah. But that's if you get the refinance for free. The average cost of a refinance is about $10,000. So instead of $325,000 that we owe, we now owe $335,000 that we owe. Now I need you to watch this. Instead of $1,554.89, the new payment is $1,602. So the bank says, just roll the $10,000 into your mortgage. It's not going to raise your payment that much, as you can see here. Okay, it didn't raise the payment that much, but it is still lower than what we were paying before. Our old payment was $2,098. Our new payment is $1,602.64. This is what makes our eyes big. This is what makes our mouths water when we focus on the payment and the interest rate instead of the interest cost. Now, let me show you this. It cost $10,000 that we rolled into this loan at the new low interest rate of 4%. Let me show you what 4% really means by just looking at how much we paid to get the refinance, $10,000. So if you added on $10,000 as your closing cost, don't you have to pay the $10,000 back first to get back down to your $325,000? Yeah, because now you're at $335,000, but you rolled in $10,000, so you didn't have to take it out of pocket and borrow money. But you're thinking, I'm borrowing it at 4%. No, 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 no. You're not borrowing this $10,000 at 4%. Let me show you why. Let's break it down. When you're paying back that first $10,000, you're paying back that first $10,000 with $480 payments, and it costs you $1,000 in interest each month just to pay back that $10,000. So let's scroll down to the first year. In the first year, you've only paid back $5,911 of that $10,000 that you've added on. You've already paid $13,320 interest on the $10,000 loan just to get the refinance. That's number one. By the time you paid the loan off, the $10,000 loan off. It takes about 21 months to do that, and $23,000 in interest. So your refinance actually cost in the first 2 years, not even 2 years, $33,000. That's how much the refinance cost, because you rolled in the $10,000. But nobody's looking at the interest cost of borrowing the $10,000 and rolling it into the loan. So if you borrow $100 and you pay back $100 in interest, folks, that's 100% interest all day long. If you borrow $10,000 from your bank, rolling it into your mortgage, and you pay $10,000 interest on that $10,000, that's 100% interest. If you're now looking at paying $20,000 interest on a $10,000 loan, that's 200% interest. And add another 3,000 to it, now we're talking about maybe 230% interest on this loan. How many of you have ever looked at it this way? How much interest you are actually paying by percentages? Over 200% interest on a loan to get a lower interest rate and a lower payment that seems to serve you now, but makes the bank more money in the long run. How many of you are tired of this kind of thing going on by not understanding what's really going on behind the scenes? How many of you are tired of that? Gersha Baptiste says, that's crazy. She says, that's crazy. She says, she wants to know. All right, let's see how we can make these numbers work for us. So let's go back to our original loan here, and let's see how easy it is to turn this thing around. What I'm doing here, and somebody's going to come in and ask me, is this what you should do? I'm just teaching you now how an amortization schedule actually works. Things we should have learned in the 8th grade. Okay? I am not prescribing what everybody needs to do to get out of debt faster and cheaper. We have a whole program for that tells us exactly what to do and when. All right? But you need to understand what's going on behind the scenes. When you make this very first payment of $348.43 and $1,750 goes to interest, you need to know how they're doing that and what's really happening. How do they get this $1,750 in interest? How do they get that? Okay, this is how they get it. The amount of the loan is $350,000. $350,000. Okay, so we're going to figure out how they do that. They're going to take your 6% interest, 6%, that's 0.06. They divide that number by 12, and they get 0.005. They take 1/12 of the interest rate and multiply it by the unpaid balance. In this case, is the very first payment, $350,000 times $350,000 equals $1,750. Do you see that? $1,750. So they don't take 6% and multiply it by the whole 350,000. The formula, which looks like this, let me show you this formula. Amortization formula looks like this. Here's the amortization formula. The amortization formula, all this formula is saying is how to take 1/12 of the interest rate, whatever the interest rate is, and multiply it by the unpaid balance. That's how much interest you owe that month. Now, there are many ways to do this. This is not the Holy Grail. This was invented in the 16th century by a guy named Fibonacci. And it has changed very little since then. Very little since then. And in 1934, banking went to this formula to make money. Now, all they need to do to keep on pulling in 80% of your payment dollars going to interest and 20 cents of your dollars going to principal, all they need to do is for you never to understand how this works. And it's not taught in schools today.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.